Ladies and gentlemen, good day and welcome to Shaily Engineering's Plastic Limited Q1 FY2024 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectation of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Amit Sanghvi, Managing Director. Thank you, and over to you, sir.
Thank you very much. Good afternoon and a very warm welcome to all the participants to the post-results investor call of Shaily Engineering Plastics. I have with me Sanjay Shah, our Chief Strategy Officer, and SGA, our Investor Relations Advisors. I hope you've had a chance to look at our investor presentation that is uploaded on our website as well as the stock exchange. Let me start with giving you some highlights on the operational performance. Despite the challenging geopolitical situation, we've delivered a top line of 157 crores, and we've improved our gross margins and EBITDA margins, which stand at 41.1% and 17.6% respectively. We've also stabilized operations in the UK, and as we scale up and move forward, our emphasis is on broadening our horizons to encompass more intellectual property development and contract manufacturing of medical devices. With that, I'm happy to announce that we have been granted patents for one of our new auto-injectors in the US market. The efforts dedicated to developing our injection system platforms are now yielding positive results. In this sector, our scope is not only extensive, but we're seeing traction with commercialization of devices in the coming months and years. I'm also delighted to announce that we have been awarded new business from General Electric with the value of 40 crores per annum. Our second largest revenue generating sector today is healthcare, and we have adopted a scalable approach that will enable us to increase our revenues at a faster pace over the next 5 years. The money that we had raised in 21 has been put into enhancing capacities and building new facilities for healthcare. We also plan to increase our own IP contribution going forward. On the home furnishings front, we have been awarded business for 3 new products where the total value stands at 50 crores per annum. We're further strengthening our relationship with the customer. We had ventured into steel furnishings business for the same customer and have also added an exclusive facility to service the steel furnishings business. We received business confirmations for additional volumes, and this will improve utilization in the current year. In the automotive and engineering segment, we've added 3 new products with 2 new customers, where the total value of the business in the current year, in the next year, will stand at 5 crores per annum, but will grow somewhere between 15 to 20% year on year from there. That is all from my side. I shall now hand over the call to Sanjay Shah, our Chief Strategy Officer, to give you the operating and the financial highlights. Thank you very much.
Thank you, Amit. Good afternoon, everyone. I shall share with you the highlights of our operational and financial performance of Q1 FY24. Later, we will be happy to respond to your queries. During the quarter, we processed 5,822 tons of polymers as against 6,760 tons in Q1 FY23. Machine utilization rate was around 43% in Q1 FY24. Exports during Q1 FY24 stood at 75% of total revenue as compared to 77% in FY23. On our standalone results, revenue stood at 153 crores for Q1 FY24 as compared to 172 crores during Q1 FY23. EBITDA stood at 23.7 crores during Q1 FY24 as compared to 21.7 crores during Q1 FY23, a growth of 9% year-on-year. EBITDA margin improved by 290 bps to 15.5% for Q1 FY24 from 12.6% in Q1 FY23. PAT stood at 8.7 crores during Q1 FY24 as compared to 7.4 crores during Q1 FY23. PAT margins stood at 5.7% as compared to 4.3% in Q1 FY23. Cash PAT for Q1 FY24 was reported at 16.8 crores as compared to 15.2 crores during Q1 FY23, a growth of 11%. On a consolidated basis, which includes Shaily UK, our subsidiary, revenue stood at 157 crores during Q1 FY24 as compared to 175 crores during Q1 FY23. EBITDA stood at 27.7 crores during Q1 FY24 as compared to 24.3 crores during Q1 FY23, a growth of 14% year-on-year. EBITDA margins have improved by 370 basis points to 17.6% for Q1 FY24 from 13.9% in Q1 FY23. PAT stood at 12.6 crores during Q1 FY24 as compared to 9.5 crores during Q1 FY23. PAT margins stood at 8% in Q1 FY24 as compared to 5.4% in Q1 FY23. Cash PAT for Q1 FY24 was reported at 20.8 crores as compared to 17.3 crores during Q1 FY23, a growth of 20% year-on-year. This is all from our side. Now we can open the floor for Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star then 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Manoj Baheti from Carnelian Asset Management. Please go ahead.
Hi. Good afternoon. First of all, congratulations on a good set of numbers. My first question is, if you can give some color on sustainability of the margins, the way we have seen decent improvement in margins in the current quarter. And then I have one more question.
Manoj, your voice is breaking a little bit. Could you...
Hello, is it clear now?
Yes, sir.
Thank you. So I have 3 questions. First one is on margins. So if you can give some color on sustainability of the margins, the way we have seen decent improvement of margins in the current quarter. And secondly, if you can also give some color on ramp up of our healthcare facility during the current financial year and how it is going to impact our margins going forward.
Okay. And what's the third question? You said you had 3 questions, Manoj.
Yeah, and third question is if you can elaborate on the new business wins, especially on GE appliances, home furnishing, and also the carbon steel ramp up in terms of improvement in capacity utilization. So these are my 3 questions on it.
Okay. If you want to take the second question first, ramp up on healthcare facility, and then I'll take the other 2 questions.
Sure. I don't think the second question was a ramp up on healthcare.
So the question which Manoj said was what sort of ramp up do we expect on the healthcare facility and an improvement in margins from that? So
yeah. So I think question 2 is a little related to question 1, Manoj. Yeah. You're seeing you will see improvement in margins as the pie of the healthcare pie of the total revenue continues to increase. Mm-hmm. So we will see. I hope that we will see marginal improvement quarter on quarter. Quarter 2 seems One where we have some new projects that have been delayed to quarter three, which means that you will see certainly a significant improvement in quarter three. May not be so much in quarter two, but healthcare continues to scale up.
Okay.
This year we are anticipating a growth of roughly 60% on the healthcare business.
Sorry, can you repeat, Amit? I couldn't hear you. You mentioned some percent.
We're on track to grow the healthcare portfolio by 60% this year in the current financial year over the last year.
Okay.
So as that happens, you will see improvement in margins, and these are sustainable margins.
Okay.
Manoj, I'll probably take the other two questions. Amit partially answered the first part of the question. And see, the improvement in margins is on basically in three counts. One is, as Amit mentioned, you're basically seeing the healthcare price go up, and which has better margin. So the overall margins are going up. Second is you're seeing improved utilization levels at the steel factory. We're having longer runs and everything, which is basically improving our yields there and everything, which is also ensuring that we have better margins there. Or the impact on the margin is lower there. So that's the other thing. It's a combination of these factors which will play out and which will see improvement in margins as we go forward. On the new business front, the GE business, we will basically, it's a knob which we are developing for them, and we will start supplies sometimes in calendar year 24. Similarly, on the home furnishings front, there are 3 new products which we are working with the customer. Revenues will start kicking in from Q4 of FY24 and Q1 FY25. So that's the timeline which is being looked at. The revenue numbers which we have indicated are annualized numbers based on the current volumes which we have got from the customer. Third business which we have talked about is on the automotive segment with 2 of our existing customers, where we're basically strengthening the relationship and adding more products as we go by, which again totals to about 5 crores a year right now. And as Amit mentioned in his speech also, we will see that business growing as the ramp up happens.
Okay. And lastly, on the carbon steel part, do you see now the stability is behind and we will see gradual improvement in capacity utilization there?
That's our understanding.
Hello?
Yeah, that's our understanding.
Okay. Thank you so much, Amit and Sanjay bhai, for taking my question. Thank you.
Thank you.
Thank you. Before we take the next question, I'd like to remind participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Nirali Gopani from Unique PMS. Please go ahead.
Hi. Thank you for the opportunity. So to start with, if you can just give a general outlook on the home furnishing side also. So we were seeing constant pressure over there due to the inflationary environment in US and Europe. So how is the situation now, and how do we see the current year panning out on that side?
So really, we are seeing gradual improvement in volumes, but you're not seeing very large improvement in volumes, but we're seeing improvement in volumes, and what we're also seeing is we are seeing new business confirmations coming in. So we are building up the business for the next year.
Okay, because all these new business wins will largely reflect in FY25, right?
So as I mentioned, some of the home furnishing stuff will start getting reflected from Q4, but the bigger impact will happen from Q1 FY25 onward.
Right. So if I want to see FY24 in particular, so largely the growth will be driven by healthcare or any other segment you see that, can support growth in any way?
The FY24 growth, as we have mentioned earlier also, will come from healthcare. Part of it will come from improved utilization levels from the carbon steel facility, where we are seeing traction in terms of higher volumes and everything. Third will basically be on automotive front and some of it on the home furnishings front. So these are 4 areas from where you will see growth.
Okay, fair enough. And this quarter saw a very good revenue uptake on the UK side. I know Amit did touch upon it in his opening comment, but if you can briefly talk about it, what kind of difference are we seeing there, and how should things look going ahead?
So, we're looking at, while we will not be able to give you exact numbers, but we're looking at a very, very significant, ramp up in revenue in the current financial year over last year. I would say at least 2 to 3x is what we're looking at in terms of revenue in Shaily UK this year.
Okay, and this is largely the new development that we are working on.
Yes, so generally the way to look at it is we have in the past communicated new business confirmations which we have received and new developments which we have received as and when they have been received. Large contracts have been closed. So that are being executed through Shaily UK. So that's the pipeline which is there, and that's the reason what Amit mentioned, the growth which we are looking at.
Right. And GE Appliances seems to be a new customer. So if you can just qualitatively share what kind of opportunity it can be for Shaily over a longer term. I know you have shared the short-term number, but yeah.
So generally, I think giving numbers will be difficult. We see pretty large opportunity there. Amit can add to...
And it's actually a very old customer. We started doing business with GE in, God knows, 95, I think.
This is our fourth export customer, Amit. Yeah.
Okay, so we have been working with GE since 1995.
Yes, but they've never had focus on sourcing from India. I'd say that focus has changed significantly over the last 18 months, which means that we are seeing new opportunities and we are participating in them, and I've also been awarded this particular project.
And lastly, Sanjay, if I see this quarter numbers, the expenses have grown quite significantly over Q4. So any particular reason, like other expense, staff cost, power and fuel, everything has grown significantly. So
some of those expenses, if you were to look at it, are in line with the growth in the revenue. Power and fuel, we have had high growth in the current quarter because there has been some change in the power tariff, and with improved utilization levels in terms of the carbon steel facility and everything, we have been having higher power costs there.
Okay. No, fair enough. That's it from my side. Thank you.
Thank you. Before we take the next question, I'd like to remind participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Aman Vij from Astute Investment. Please go ahead.
Good afternoon, sir. My first set of questions is on the pharma business. So on the capex side, if you can give an update on when is the pharma capex expected to complete, and how do you see the ramp up in FY24 and FY25? When do we expect full utilization of this facility?
So, Aman, we will basically be completing major part of the capex by September. And so Q2 is by which the major part of the capex will be done. Some of it will get spilled over to Q3, but between Q2 and Q3 of FY24 is when the whole capex would be done. The ramp up will basically be over the next 4 to 6 quarters when we will do the ramp up. In pharma, we need to have facilities created ahead of time to basically get all the compliance and all the approvals from customers. So that's the basis on which these facilities have been created.
You look at a 3-year, at least a 3-year horizon for the capacities that we have created to be utilized to a greater extent.
Sure, Amit. And is my understanding correct that almost maybe 2/3 or even more is meant for pens, this new facility? Is my understanding correct?
All of it for devices. Yeah.
Sure. And in terms of, you've talked about what kind of growth we see in healthcare. In terms of number of pens sold, so where do we target? What is our target for this year?
Aman, I honestly think when you just look at the total number of pens, it probably does not give you a right sense because we sell pens at different price points. And we have contract manufacturing for our own devices, and we then have our own IP-led pens. Each of these pens have different price points, and the price variation is very, very large. So looking at total number of pens, we can give you a number or something, but I'm not sure whether it will help you in terms of looking at that number.
Okay, so if we have to say, can we assume the growth in pens, not the number of pens, but in the pens business, in terms of, say, rupees crore business, will be in proportion to 50-60% kind of growth we are targeting in healthcare. Is my understanding correct?
Yes.
That's right. Yeah.
Sure. On the utilization of our facility, so it was good to see the ramp up happening in Q1. So if you can talk about for FY24, what kind of utilization do you think we can achieve? And similarly for next year, if you can talk about the same.
Well, we don't give out what we think will be revenue guidance or something for the current year or for the next year, so we would refrain from answering that question. Probably answer it in a little different way. As business improves, you will see utilization levels improving going forward.
Mm-hmm. So the reason for asking was, when do we expect the full utilization of the facility? That is the question. If you can talk about the same.
My sense is probably sometimes by the second half of FY25.
Sure. On the steel business side, last time you had talked about, I think it was still loss-making, if my understanding is correct. So if you can talk about, do we expect this to, is it profitable in Q1? When do we expect it to become profitable? And again, you had talked about FY25, we expect full utilization. So is it safe to assume that even for FY24, we can maybe do like 50-60% kind of utilization?
Yeah, so I think this year we will be positive in terms of bottom line and everything. In terms of utilization levels as compared to last year, we are at an improved utilization level. We will be over the numbers which you indicated in terms of utilization levels for the steel facility for overall for the whole year. Getting to 100% for full utilization FY25 is a little too early to say right now. We are working with the customers to build up the book in terms of products and everything. If we have clarity, we will give that clarity to you.
Sure, sir. And final question before I come back in the queue. Any positive offshoot on the toys business? If you can talk about the same.
No.
No.
I don't think there's anything right now.
Okay. Thank you. I'll get back in the queue.
Thanks, Aman.
Thank you. The next question is from the line of Paras Adanwala from Capital Portfolio Advisors. Please go ahead.
Yeah, I had a question on your fixed asset turnover ratio. I saw a peak, my software says that in March 2018 is when you had a peak fixed asset turnover ratio of 2.6. And since then, there has been a gradual decline. And, I think as of FY23, it's lower than 1.5. So would you say that with this quarter, now, the fixed asset turnover will start improving?
So far as we have said in the past and that based on the investments which we have made in everything, we should basically be looking at investment, fixed assets investment to revenue of somewhere between 2.25 to 2.5x, depending on the current product mix and the customer profile which we have. I think you will basically see that ratio improving as we move towards the end of the year. At the same time, what also needs to be looked at is we are capitalizing a large part of our pharma facility in Q2 and Q3, which will increase our fixed assets, where you will see revenues coming in over the next 2 to 4 quarters.
Okay. So do you think over the next 12 to 18 months, you should be reaching a fixed asset turnover ratio of close to 2.5, 2.6 once again?
I'm not sure whether we will get to that level, but you will see that number improving. Once we have better clarity, we can probably talk about it. But yeah, we do see that ratio improving. And
Bars, the only thing I would add is, maybe not 12 to 18 months. Look at more from 18 to 30 months, and you will certainly see, like Sanjay Bhai said, that number improving.
Okay. And through the course of various conversations today in the call, you mentioned about clarity and unpredictability. So, are you in the overall business environment? Are you witnessing some amount of haziness in terms of how you see your future over the next 12 to 15 months?
Somebody want to take that or?
Yeah, I will take it. No, I think, Paras, it's not so much haziness on how business or the environment is. The environment is certainly not great right now. We don't think we're not going to see a full recovery in the current year. And we've said that at the beginning of the year as well. I think the haziness comes partially from, there's so much movement on this, whether you call it China plus one or just people looking at alternate sourcing, India being a great part of that strategy. So there's so much opportunity, but, it's just about finding the right opportunity that we want to participate in, where we can make a contribution that will help us to build a to have sustainable growth as well as profitability. Toys is a classic example of how we tried to de-risk from our home furnishings major, saw an opportunity which could be scaled up fairly quickly, had very similar margin profile or slightly higher margin profile than the home furnishings major. But it's not a business where, where our abilities are valued, to be honest. So do we want to continue down that path? I would say probably not. We will certainly participate in high value add opportunities if they come our way, but it's not a business that we will actively pursue with the customer because it doesn't, there's no stickiness to the supplier. This is basically a very transactional relationship, and I don't think it enables long-term growth. So the haziness probably came from building that strategy for Shaily more than the business environment.
Okay, all right. Okay. And now we've been, I think FY23 was quite a challenging year for you. And even prior to that, I think we did notice some amount of slowdown in the business. But now with this quarter, would you say that things have turned around and we should at least cross the turnover or reach the turnover that we had in FY22?
Give it one more quarter. I think we're gonna have the jump we saw between March 23 and June 23 may not be there between June 23 and the coming quarter. So we will certainly see an increase, but it may not be so substantial. I think quarter three and quarter four will see much better numbers.
Okay. Just two more questions. On the toys business, it is still, kind of just it's a work in progress, as it seems right now. Can I know, what is the amount of investment that you made in the toys business, and what is, as per your budget, what is the kind of payback that you see on the investment?
So far as we've invested somewhere between 25 and 30 crores on the toy business. That's mainly in molding machines and other facilities which we have created. Mm-hmm. We will be utilizing the molding machines for the businesses which we have. So that will, as the other businesses also grow, that facility would be used for the other businesses.
No, so would you say that the payback would be in what, say 2 years, 3 years? What's the kind of estimate that you have in your plans?
When we took on the business, the estimate was that the payback would be somewhere close to 5 years.
Okay.
It will probably get stretched a little bit more.
Okay. All right. Okay, because as of now, it looks like you have only one client in the toys business.
Yeah.
Okay. And finally, on the margins, 17%, I think that's a very decent jump that you've seen. You did give some clarification on the margins. But would it be fair to estimate that now this is something which is sustainable, or would we see some kind of volatility as we move along?
Paras, I think these are sustainable margins if you look at it more from a long-term or a medium-term basis and not look at it on a quarter-on-quarter basis. Mm-hmm. And as Amit also indicated earlier, as the pharma business grows, overall margin should improve.
Okay. No, any question that I'm asking you, Mr. Sanjay, is more on an annual basis rather than quarterly. I fully understand quarter to quarter, is very difficult in a volatile scenario like today. But
I just wanted to clarify that because I should not be misunderstood.
Yeah. So on an annualized basis, I think what you've done in this quarter seems to be absolutely sustainable, right?
Yes.
Okay. Great. Thank you very much and all the best.
Thanks, Paras. Thank you.
Thank you.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Harshil Sethia from AUM Fund. Please go ahead.
Hello, sir. So 2 questions. One is regarding the carbon steel business. What level, you mentioned in your presentation that you're going to improve utilization, just given the long lead time so far. Where do you see that, the end of 24 and maybe 25 based on your current conversations?
So, based on, if you were to look at last year to this year, we'll basically be improving our utilization levels by 100% over last year. And we are working with the customer to see how we can improve that from that percentage to the next year also. Further improvement next year.
So last year was a very small base. Just trying to understand the absolute percent of utilization, because this was obviously a dedicated plant for a specific project and different from our other strengths in the plastics areas earlier. So just trying to understand, at what point will it come to the level that was originally anticipated when we made the investment? You think it'd be around the 50% range by the FY25 or the end of 24, or you don't think so?
It'll be at 50% plus for FY24 for sure. Closer to 60 plus. And then we should probably be looking at improving that on the year after that.
Okay. So on the same tone, is it possible to just get a sense of, the current utilization levels for both the home furnishing major, the dedicated project, the automotive, and the G business?
We typically do not give out individual utilization levels, and it will be difficult for us to do that.
I know. I just say that are
also fungible across businesses, and putting out this sort of information in public domain will not be correct for the company.
Fair enough. I don't know how we can get this because, given that our business model largely consists of, dedicated plant and machinery for dedicated customers, and overall utilization of 42 just seems a bit low, especially when nothing seems at a very early stage. We put the carbon steel on the side for a moment. So just going forward, how do you expect, on average for continuing businesses, should we expect, margin, overall utilization to be, higher than this, or how do you look at the business model, Once the business has stabilized, what kind of consistent utilization you would expect to achieve?
We expect utilization levels to improve. Sorry, Amit, go ahead.
No, go ahead. I thought you left that for me.
No. I said we expect utilization levels to improve. So probably by the end of the year, you should see some improvement in utilization levels from where they are currently. And then you would see further improvement in FY25.
But you also have to keep in mind that our new pharma facility will, like Sanjay Bhai mentioned earlier, will go on stream and will be capitalized in the coming quarter, which means that while utilization of the existing business will improve, existing capacities will improve, when you look at a number on the presentation in the coming quarters, it will also include the new facility. So likely that the number is going to be, not change very significantly. It'd be either marginal or no change at all.
Sure. No, it was not the question related to you. As I said, for new business, we understand they take time to ramp up. But once they have stabilized, how do you think of the business model when you take new business? Do you expect that in year 2 at least, do you expect a healthy 60-70%? I'm not asking of specific business, so you don't need to worry about that. But just when you take on new businesses, is it okay for us to expect that in year 2 after stabilizing, you should get to a 60-70% utilization level? Because that's what gives us, reasonable return ratios, etc. Otherwise, it kind of takes these long lag lead times, really reduce our cost of, reduce our return on capital.
Absolutely. No, and the answer is yes. We should in year 2 expect 65 to 70% utilization at a minimum. And unfortunately, if you look at the consumer portfolio, that's also how we kind of cost it out. So if it doesn't happen, we're increasing our payback period by that amount. And very unfortunate what happened in FY23, but we should have, at the beginning of the year, we had a solid business plan. This happened. Forecast kept coming down, kept decreasing. In FY24, we're not seeing a full recovery. We're seeing slight improvement, which is why I said that look at a horizon of 18 to 30 months, where you'll see our utilization levels improve substantially.
Great. And last question, maybe just an addition on the same tone that, what I guess happened with the toys and the steel businesses, I think they were slightly different for us. But going forward, do you kind of see new areas as well where it could be required, very different processes and different products from us, or you expect more growth coming from generally, products aligned to our plastics abilities and, maybe with some more fungible capacity?
I think we're looking at improving from a capability perspective. We're looking at making enhancements when it comes to complex assemblies. I mean, we do complex assemblies in pharma today, but, we're now looking at doing even more complex assemblies with more components. So a typical bill of material would run into, let's say, upwards of 70, 80 parts in a particular sub-assembly or a product. So we're trying to gain that capability, also look at various means and ways of automating part of these processes. Because going forward, if we don't get into complex products, then we're going to end up eroding our margins at some point. So getting into more complex products means that we will need more value add and more manufacturing processes and more complex processes.
Okay, so more, I guess, somewhat similar to what you've done with injectables. Is that fair?
Yeah.
Okay, thank you so much.
Thank you.
Thank you. The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, sorry, I joined a bit late. Couple of questions. First is, last year we were looking to hire a new CEO. Any specific update over here? Any change in thought process? That's the first question.
I am very hopeful, Ritesh, that we will be able to give you an update in the next quarter. So our next earnings call, we should be able to give you an update. We had paused the process in the last financial year, looking at the decrease in forecast. We restarted it about 3.5, 4 months ago, and we have been actively interviewing, and we have released offers. So we hope that we will be able to give you more concrete details in the short term.
Sure. And if we had to appoint a CEO, what objective will it attain for the firm? Any specific KRAs that you have drawn out for the new appointee?
Given we're a manufacturing organization, a very strong emphasis on operations. But what we have looked at in the candidate or in terms of the profile is we also wanted someone with a technology background, which means someone who's extensively worked on product development. And above all else, it's the organizational building of an individual, from that perspective. So we're looking at a person that's obviously a good cultural fit with Shaily, but can also build the organization, take the teams along, take the people along with the growth that we see coming.
Sure. There might be some background noise. I'm sorry for that. I have a few more questions. Amit, you did indicate about utilization levels to move up from an 18 to 30 month duration. Just trying to understand how do we come at this time frame. Are there any specific underlying variables that you are monitoring? Is it the inventory in the channel or the order book position? If you could give some color, that would be really useful.
So on the pharma side, we have mentioned a few times before that we will see one of our first big products being launched in 25, not FY25, in calendar 25, which is why I said that look at a horizon which is higher. Plus the fact that we're putting in new capacities right now means that we will only see that ramp up over 3 years at a minimum. With the existing business, we know that the current year there is slight increase, but otherwise more or less muted from the last year. And the hope is, or not the hope, but the hope is that there will be a global recovery post the next 12 months, which is why I look at a horizon of 18 to 30 months. Even if there isn't a global recovery on the existing business, we are adding new strategic businesses that should see our utilization levels go up.
Right. So I think you detailed about pharma, but when we look at home furnishing, is there a channel inventory element that we are looking at? How should we understand this part of the business?
Yeah, go ahead, Sanjay.
Go ahead, Amit. Go ahead.
No, I was just going to ask him to repeat the question because I heard a lot of background noise.
Okay.
If you got it, please ask.
On the front also, what we monitor is not the inventory, but the 52-week rolling forecast which we get on a weekly basis, and we are seeing some traction or some improvement there, and that's what we constantly monitor. We are also adding newer products. We just talked about 3 new products being added, which we will be commercializing by Q4 and Q1 of in the next year. So which will also lead to an improvement in utilization level. So it will be a combination of new products and increase in volumes on the existing products, which would improve utilization level.
Sure, this is helpful. Amit, just a couple of questions on the pharma side. I think a couple of quarters back we had indicated that we are very hopeful that we can actually develop the revenues in a 3-year time frame. So where are we on that? And I think Sanjay Bhai did explain that number of pens is not the right way to look at. But historically we have given a number that we have capacity of around 20 million pens. And I think last year we had around 6.8 plus pens which we had sold. If you could quantify the number of pens purely from a capacity utilization, just from an understanding standpoint, and the headline number of doubling the revenues on a 3-year time frame, should we look at that number by FY26-27? How should we look at that?
So Ritesh, we're looking at a 60-70% growth in the current year, which means doubling the revenue in 3 years is going to happen, as we had indicated in the past. On the pens, in terms of absolute numbers of the pens also, we are looking at nearly that percentage increase. I would say maybe not as much as 60%, but a very substantial increase in the number of pens that we'll be selling in the current year as well. With the new capacities coming up, we're adding another, we've added capacities to manufacture another 20 million pens. But that ramp up is not going to happen in FY24. You know, it's going to take time. So we'll see some volume in 24, then steady increases over 25 and 26.
Sure. Just one last question. Sanjay Bhai just indicated that there's 90 crores of incremental business which will flow in from Q4 and Q1 onward. Is this all margin accretive?
Is it margin?
Accretive? At EBITDA level. The reason I asked this, earlier we had this scenario wherein when we deal with the home furnishing major, we were asked to do the tooling capex, and hence it was imperative to look at numbers from a PBT level. So how should we look at this 90 crores of incremental orders? First question, is it accretive at EBITDA margin level, and if you could give some color at ROC? And secondly, is there some tooling capex element which is there over here, or is it not something which is relevant? Thank you.
So Ritesh,
there will be some. Yeah, go ahead, Sanjay.
So Ritesh, if you were to look at it from an ROC perspective, yeah, it will be accretive. At an EBITDA level, it will be more or less similar levels of EBITDA which are there on the current system.
Okay, and from a tooling capex standpoint, is there some incremental commitment that we have to go for?
No.
Sure. This is helpful. Thank you so much.
Thank you. The next question is from the line of Richa from Equity Master. Please go ahead.
Sir, thank you for the opportunity. My question is on this order from GE Appliances. Just wanted to get a sense of, do you see stickiness in this kind of order, and what kind of run rate going forward? Will it grow over time, or as of now we don't have that sense? If you could give some color on that.
We have been working with this customer, as Amit mentioned, since 1995.
Right.
We have close to a 30-year relationship with this customer. And all the current products also which we do, including these two new products which we will be doing, we will be the single source for this customer worldwide.
Okay.
So and yes, we are looking at growing this relationship, as Amit also mentioned earlier in his speech, or one of the questions when somebody asked, we are looking at growing with this customer and look to add more businesses in the year.
Okay. And sir, let's say if we speak from 3-year perspective, how do you see the business mix changing between pharma and non-pharma? And the reason I'm asking is that I just want to get a sense on what kind of margin from a longer term perspective should we expect?
So I think pharma will grow at a much faster pace as compared to the overall business, and that will basically mean you will see margins improving from a 3-year perspective.
Okay, so basically from what kind of margins do we have in pharma? I mean, can you give any kind of range? It's not
No.
Sorry.
Okay. And sir, could you also talk about or give some more color on the process of winning new orders, new clients, something like that?
Probably didn't understand your question. Can you explain that a little more in detail?
Yeah. So let's say we got the toy business a few years ago, and currently you're saying that, we have got an order for which we'll be the only client. I understand this client is like a long-standing client, but when it comes to targeting new clients and new areas, if you could, add a little more color on what is the process, to increase visibility on what we are doing and targeting clients and targeting new business stuff.
So there are a few areas that we're actively pursuing. Like I said, we prefer to get into more complex products which fit our capabilities and engineering strength, and not highly commoditized businesses. With that in mind, hello?
Yeah, go ahead.
Am I audible?
Yeah.
With that in mind, we are working with a few companies to see how we can start a relationship. You'll see again the theme is basically consumer electronics, appliances, and even industrial applications. So at this point, Richard, it would be immature for us to shed any further light or give you any names, but as the conversation matures and we actually have something more concrete in hand, we will be providing an update.
Okay, fair enough. And sir, any kind of guidance on capex for this year or in the coming 2 years?
I think capex for this year, we have already indicated that whatever we are doing on the pharma front and our tool room is what we are doing. We will not be doing any large capex than that in the current year. Next year will again be basically looking at see how utilization levels improve on the other business front, and once they improve, we will basically be looking at capex.
Okay. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Priyank Parekh from Abacus Asset Managers. Please go ahead.
Yeah, thanks for the opportunity. Just wanted to understand, what sort of metric you track for your operational purpose. Is it like per ton revenue, or per ton realization, per ton GP margin, what GP, or absolute number you track, or it is certain percentage of GP margin on this much revenue? So how you look at internally?
Priyank, could you just repeat your question, please?
No. So wanted to understand, when you are planning your business internally, what metric you target? Is it absolute gross profit per ton, or is it percentage of revenue, or something like that? So how you plan it internally?
So we never look at gross profit or on a per ton basis. I mean, we never look at on a per ton basis. There will be different matrices which we will look at. What does the business do to existing capacities? Are there investments required? What sort of an EBITDA margin or ROCs or something which are there given to us?
But Sanjay, I think internally there are a few expense lines that we look at in percentages of revenue.
Yeah.
But most of our internal operational metrics would be measured, for example, what is the material yield? Material yield typically for us, a target would be 98.5 or 99% plus, which means that we don't want to scrap raw material more than 1%. We look at downtime, cycle time, cycle efficiency. So if we've gotten business at a 30-second cycle time from a customer, as an example, then is the plant running the machine at 30 seconds? Is it running it at 32 seconds? Or is it running it at 28 seconds? So these are the type of, parameters or indicators that we track internally.
Okay. And in last Concall, you indicated an expected utilization of 50 to 55% for FY24. So is it going to be same even today?
I think Amit just answered that earlier. Whatever we are currently, we will see some improvement, but it will be a gradual improvement over the current year. That's what he indicated also.
Okay, so 50 to 55% would be the right number to take.
I think we're not given a number, and we would refrain from giving a number there.
Okay, fair.
You will see the improvement in the coming quarters.
Okay. And that.
Thank you very much. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for their closing comments. Thank you, and over to you all. Members of the management.
Thank you.
Yes.
Yeah. Thank you, everyone, for joining the call. We hope that we've been able to answer your questions adequately. For any further information, I request you to get in touch with SGA, our investor relations advisor. Thank you and have a great day.
Thank you. On behalf of Shaily Engineering Plastics Limited, that concludes this conference. Thank you all for joining. You may now disconnect your lines.